Good evening and welcome to another episode of the Weekly Market Wrap. And for this week, we're going to title this presentation as 2024 Year-End Market Volatility, Opportunities and Risk. Of course, we knew that today is the first day of December and we are definitely going into the year-end. And it has been quite volatile this couple of weeks ever since Trump win the presidential election on November the 5th. And definitely he will be continuing to create ripples across financial markets with his rhetorics. And today we also hear that he is again harping on tariff. Later on, we'll be talking a little bit about that as well. Okay. And we are going into year end, and definitely 2025 is beginning. And definitely, I think 2025 is going to be a monumental year as well. Okay. Now, before we go into the content itself, I would like to acknowledge the sponsor for this event, which is IronFX, a broker with presence in over 180 countries, offering more than 500 tradable instruments for trading. And they has been very generous in sponsoring my event, and I want to acknowledge that right here. And of course, the content that I'm going to share with you, this presentation is not an offer to buy or sell any kind of security, be it FX, CFDs, and must not be construed as investment advice. And the trading of any kind of margin products do carry risk. Do understand that, and please understand your own risk tolerance before you attempt to trade any kind of margin products. And I'll be sharing with you my views on the various markets, and do understand those are my views and has got nothing to do with the sponsor. And we are collectively not going to be responsible for any action that you may take after this event. And the content of this presentation obviously has not been vetted by any regulatory body. So with this out of the way, I want to walk back a little bit on what has been happening in terms of news. Okay, so we knew that Donald Trump has threatened to impose a 25% tariff on all products on their closest neighbor. Okay, now remember, during Trump's first term, he actually abolished NAFTA and introduced another new trade agreement for Canada and Mexico. And now he is threatening both their trading partners in Canada and Mexico with additional tariff of 25% on something that is nothing to do with trade. And he's trying to say that, okay, now we have a lot of drugs and a lot of illegal migrants moving into United States, and he's using tariff as a weapon to whip them into controlling the border for him. And this is definitely not something that we want to relate to. And Mexico actually has retaliated that they will be looking to impose a counter tariff on US imports into Mexico. And as of this weekend itself, we knew that the Prime Minister of Canada, Justin Trudeau, has went to meet up with Trump to see if he can strike some kind of deal. And we can see that this is obviously causing a little bit of discomfort among their closest neighbor. Now, remember, during Trump's first term, the new agreement that he has actually constructed with both countries in replacement of NAFTA, which he claims to be unfair, actually within the agreement itself, there was one clause that says that no countries can impose unilateral tariff on each other. And by the fact that he's now announcing a 25% tariff on Mexico and Canada itself, is in effect going back on his words. Okay, so this is something that we will have to consider. Not sure whether Trump is posturing. I believe he, being the businessman that he is, I think he always put out a red hearing, and then during negotiation, he will be able to actually walk back on those threats. This could be one of those times in which Trump, the negotiator, is definitely trying to create something out of nothing, and then then negotiate from a position of strength. I think this is what it is. And obviously, right now, Mexico is the largest trading partner of United States after Trump actually has reduced a lot of imports from China. So Mexico has become suddenly the largest trading partner of the United States. Definitely, he doesn't want to impose additional tariff on Mexico because the US now imports a lot of basic necessity from Mexico. And Canada is also the other major trading partner for the United States. After all, they sell the United States a lot of oil, definitely a lot of lumber and aluminum. So all these products that goes into the United States is definitely going to impact the Americans' domestic economy if those tariffs comes into being. Like I say, I do not believe this is going to be the real case. I think it is just uh, to have a better negotiation position relative to Canada and Mexico. Okay. Now, Mexico president has actually vowed to retaliate, and now this we already knew. During the phone call in which the Donald Trump has actually have with the Mexican president, which is the lady, Trump actually jumped the gun. They said that he actually has a deal with Mexico, and Mexico is going to control the unmitigated inflows of immigrants through their border. But the Mexican president came in shortly thereafter. Trump made that statement and said that there is no such deal. Okay, so again, this is something that we want to see. I think the strong woman in Mexico is definitely not going to play the game that Donald Trump wants to play. Now, Canada has actually also vowed to actually increase the border securities, very much a language that Trump would like to hear. But I say this agreement, this threat to impose additional tariff has got nothing to do with trade and everything to do with controlling the border. Okay, so Trump actually uses tariff as the go-to weapon to achieve everything that he wants to achieve. So let's see what happens when the time comes and if there's going to be any effect. Okay. Now, the other big news is the current incumbent, President Biden, has actually announced a peace deal between Israel and Lebanon at the beginning of the week. And this deal suggests that there will be a 2 months peace deal in which there will be no firing, there'll be there's no exchange of fires between the two antagonists. Okay. However, within less than 24 hours after this deal was announced, uh, fighting has renewed. Okay, so this is very, very difficult to actually has a deal because both sides have too much animosity between them, and I do not believe that anytime soon peace will return to the Middle East because their their issue with each other goes back, decades and perhaps even centuries. So this is going to be very, very hard to resolve. And like I said, Israel accused Hezbollah of violating the ceasefire. And the fact is that Israel had a peace deal brokered by President Biden with the Lebanese government, not so much with the Hezbollah militant. Now, we all knew in Lebanon, the national government does not have full control over its territory. I think the militant called the Hezbollah has been more dominant. And this peace deal between the government of Lebanon and Israel does not get the approval of this Hezbollah. So that's why I say this deal is going to be very fragile. And we already knew what happens. And Israel has actually retaliated by firing into Lebanon, the southern part of Lebanon. And also the deals do not, or rather does not require Israel to withdraw back to the border. Right now, the Israeli forces are in southern Lebanon, and they do not have to withdraw back to the border for 2 months. So I'm not sure whether this lopsided peace deal can actually hold. We have already seen that it is very, very fragile and is getting ready, may actually be broken again in the days ahead before the 2 months is up. I suggest, I rather think that this peace deal, so-called peace deal, is actually Israel buying time to restock. Okay, they have been on more than 1 year of war with both Lebanon and carrying out military operation in the Gaza. And I believe that their stockpile of weapons may have already been dwindling. And I think they are using these 2 months to actually restock. So let's see what happens after President Trump's get into office. Okay, so this is the latest that we knew as far as the Middle East is concerned. But as of yesterday, on Saturday, Trump actually again taking out his tariff and said that he is going to impose 100% tariff on all BRICS countries, and so long as they are pursuing a to bypass the dollar in their trade payments. Okay, so this is even more reason why I think countries in the global south wants to pivot away from the dollar, because first the Americans weaponize the dollars and then weaponize the payment system itself, and obviously countries do not feel comfortable. They want to find an alternative, and BRICS come along and say that we are building an alternative payment system, and you really cannot get people to go back to using your currency after you have threatened them and you have actually proved that you weaponize the system. So not sure how Trump is going to get people to use the dollar again, okay? But he is again taking up the tariff threat and say that he's going to impose 100% tariff on these countries if they do not use the dollar as the payment currency. And this afternoon, I saw another news that said the BRICS are definitely going ahead with the new payment system. So not sure how this is going to pan out, but I think we will probably end up with two different blocks of trading correct payment currencies. Okay, so this is an evolving thing, and then we will see how this thing evolve. But it's definitely not good because the world is going to be divided on two different standards and two different payments systems. Okay, so definitely it's going to be fractured. Now, that is out of the way. Let's get into the data itself. At the beginning of the week, we have New Zealand releasing their retail sales. It actually wasn't as bad as what the market was expecting, and there was no expectation. But when we compare it to the previous month, previous quarter, for example, in Q2, we can see that there has been quite a bit of a improvement in terms of retail sales. In Q2 of this year, you can see retail sales in the New Zealand has actually shrunk to negative 1.2%, and the latest quarter saw an improvement, now back to the borderline case of zero. Okay, we still it still registered a negative 0.1%. There is no growth in the retail sale, but it is improving from where it was in Q2. So is this going to be something that the New Zealanders can cheer? I'm not sure about this, okay, because I can see that there's a total collapse in the consumer spending in both Australia and New Zealand. And this is something that we also want to watch, if especially you are trading the Kiwi dollars. So you want to watch that the Kiwi dollars has recently rebounded this week, but that is not so much on the strength of the Kiwi dollars, but on the profit taking that we are seeing in the dollar. Okay. So in Australia, we can see consumer prices has not really improved. It stays stagnant at 2.1%. This is on the lower end of the scale. In fact, if you look at the number from all the way from January of last year, with consumer price index on a month-to-month, on a year-on-year basis, is actually at 2%, very near to 2%. But is this something that need to be celebrated? The Reserve Bank of Australia has been very reluctant to change the monetary policy, because if they cut interest rate, okay, this number is going to shoot back up again. Okay, so at 2.1% is definitely a much better picture compared to where it was at the beginning of last year. But again, I think the central bank in Australia is very, very cautious, and that has saw the Aussie dollars been sold off until the beginning of this week. Okay, now if you have any questions, do put them into the Q&A, and we will address them as they come along. Jim, I'm not sure, are you new to this webinar? I've never seen your name before. Jim is asking, how will the tariff on BRICS country, if implemented, affect the US dollars? Not so sure whether he can actually impose any kind of tariff, because at the end of the day, demand and supply is willing buyer, willing seller. Okay, the reason why the US has such a huge trade deficit with the rest of the world is that the Americans do no longer produce the thing that they need. Okay, so they have to import those, and unfortunately, those essential products are coming in from Asia and the rest of the world. So we can see that the BRICS nations are the global south, and they do produce a lot of things that the Americans need. So if they do not want to trade with the United States, I think they are perfectly fine. We have seen how China has actually maneuvered themselves outside. Although trade with the United States has not collapsed in absolute terms, we can see that it does not impact China global trades with the rest of the global south. In fact, on on a consolidated basis, I think China uh, uh, share of the global trade actually increased, because while the export into the United States has met with a lot of tariff, China has actually pivoted to selling more to the global south. So China does not really need to sell to the Americans. Okay, so if the trade does not involve selling to America, and if the BRICS countries do follow through, I don't think the impact will be that severe, because they are trading among themselves and they are using their own currencies to trade among themselves, bypassing the dollar altogether. So we can see that the US hegemony has always been two things. One is the dollar itself as the global reserve currency, and the other one is their military. Okay, and they both support each other. So we can see that if you take away one leg of their hegemony, which is the use of the dollar as a payment currency, it will knock off one leg of this structure. And I think the US is very much aware that if the world stop using or decrease the use of dollar as payment currency, the hegemony will end. Okay, over time it will not happen immediately. I don't believe the dollar is going to disappear altogether, but their role in the global payment system is definitely going to be reduced over time. So not sure how this thing is going to work. Okay, I don't believe the global south needs to sell to the Americans, and if they trade among themselves, America will have to import whatever they need from somewhere, and eventually they will realize that they have to trade. The Americans will have to trade with the global south eventually, because US no longer produce the basic stuff that they need. Okay, so I think that would be the consequences of this threat to impose additional punitive tariff on the global south. Now, we also see the Reserve Bank of New Zealand adopting a very different posture from the Reserve Bank of Australia. Now, at the beginning of the rate tightening cycle, I remember the Reserve Bank of New Zealand was one of the very first to actually hike interest rate before, I think 6 months before the Federal Reserve start to hike interest rate in March of 2022. Okay, we can see in the last quarter of 2021, the Reserve Bank of New Zealand has already recognized that inflation is a problem, and they started to hike interest rate way before the Federal Reserve hike their interest rates. So now we can see that the Reserve Bank of New Zealand is taking a very proactive approach to actually trying to revive growth, because you can see that the economy in New Zealand is actually tanking. Okay, so now that they see that inflation is coming back down, as we saw the last number that we saw on the CPI numbers in Australia, which is quite a mirror image of what we are seeing in New Zealand, and definitely that gives them the cover to actually start to cut interest rates in the hope that the economy can rebound. So this is definitely in reaction to the slow economic activity in New Zealand. Okay, so we can see that this is definitely a country that has been or rather a central bank that has been very proactive in in reacting to the reality on the ground. Okay, so the current interest rate is at 4.25%, and this is even lower than the United States right now. Now, the core CPE number, this is the highlight for the week for the United States. Now, we all knew that the Federal Reserve do rely on the personal consumption expenditure, especially the core, which is to remove the food and energy component, and they look at this number to decide on their monetary policy. However, we can see that there are two charts here. On the chart on the left, which is the month-over-month number, we can see that the core personal consumption expenditure has actually rebounded since May of this year. And although it did not further increase in October, but it has been elevated. Okay, the low was actually 0.1%. Now it's 0.3%. If you look in terms of percentage basis, this is 100% increase from the 0.1 that we saw in May. So this is definitely a concern. And when we look at the year-over-year number, again, there is no sign that the year-over-year number is getting worse, but it is not improving as well. It is stuck at 2.7%, and this is the third month in a row it has been stuck at this level. Okay, the consolation is that it has not gone from bad to worse, because the market was expecting a 2.8% relative to the previous month of 2.7%. So depending on how you look at it, you can cheer that this number is not getting worse, but on the other hand, it is not getting better. Okay, so a lot of people is asking, the question is, has the Federal Reserve been too fast to cut interest rate as aggressive as it did starting in September 18, when they cut interest rate by 50 basis points? And we are going into the December. In fact, we are already in December, sorry. And there will be one more FOMC meeting, and market is no longer very, very sure that there will be another rate cut this month. There's a possibility that the Federal Reserve will sit on their hand and decide not to cut interest rates in December. And if they do cut, is most likely to be a 25 basis point at most. Okay, so going forward, I think the Fed has already been sending out signal that they are not necessarily looking to aggressively cut rates going to 2025. So any expectation of any more rate cuts is not in the horizon right now. In fact, we can see that the dollar has actually rebounded from September onwards since the Federal Reserve cut interest rate. Normally, in the interest rate cut cycle, when the Federal Reserve cut interest rate, the dollar you will usually go down. But we have seen over the last 2 months, the dollar index has actually increased by more than 8%. From the low in September 27 all the way to November 27, the 2 months period, I think the dollar has basis the dollar index has actually increased by 8%. So this is definitely something that will actually puzzle a lot of traders. Why is it that the Federal Reserve cut rate and the dollar strengthened and by 8%? So this is something that we have to watch, because at the same time, there's definitely a lot more weakness in the global economy. So sometimes when we look at the dollar, we don't necessarily look at the strength of the dollar. We also have to look at whether the other trading partners, okay, let's say for example the G7, how their economy doing. Definitely in Europe, across the entire spectrum, you can see Germany, France, UK, they have not been doing well. In Asia, we also look at Japan, and it is also not doing well. China, being the second largest economy, is definitely not doing too great. So we can see that it's not so much the strength of the dollar, it is actually the weakness of the other major economies. So going forward, will the dollar continue to weaken? I have my personal view. I think this week itself, starting from Monday, the dollar has actually pulled back. And I think this is a correction within a correction. So if you are trading the dollar, I think do expect a little bit of a bounce before the dollar goes back down again. And watch the structure. I think it is going to be a three-wave corrective pullback within a much larger three-wave bounce. Okay, so again, you want to watch how the dollar performs over time. Now, the GDP, as far as the US is concerned, there's no change, no surprise here. It remains unchanged at 2.8%, a very respectable number considering the rest of the world is not doing as well. So US has been quite stable in as far as the GDP is concerned. Although it did not do as well as in Q2, but it's 2.8% in Q3 is as good as it comes. So there is no surprise here. So we did not get any kind of reaction in the marketplace when this number was released in the middle of the week. Germany CPI, you can see that on a month-over-month basis, again, when you measure inflation in Germany, there are two sets of numbers. One is the CPI number, which is not so much the dominant index that people look at, but it is still an inflation number. The month-over-month number, you can see there has been a major improvement. It actually went into negative. So this is a bit of a concern because this is considered as disinflation. So if prices are going backwards, that means companies cannot charge the right price, or companies will obviously want to charge the right price for the goods and services. And if they can't, that means to say that consumers in that country, in Germany in this case, is not able to pay. Okay, so we can see that there is a negative growth in the CPI number month over month. This is definitely not a good sign. Too strong a number is not good. Too bad a number like this, what we are seeing, is also not good. Okay. In fact, at negative 0.2, this is the weakest number we have seen this year in Germany, month over month. However, the year over year number, we can see that is a bit of a contradictory here. Prices in the CPI numbers year over year has been climbing for the last 3 months. Okay. So if you want to look at this number, you want to look at the year-over-year number. Of course, the month-over-month is definitely more sensitive, but it's a little bit of a noise here. But you can look at the year-over-year number. Prices are beginning to creep up again, and this is going to be a double whammy for the German consumers. Okay, let me see if there's any other question. So again, keep your question coming if you have any. Here we have the other inflation number, which is the harmonized index of consumer prices. Again, this is the more, I would think, the more watched data, okay, compared to the CPI. The harmonized index of consumer prices attempt to smooth out the fluctuation. So it's definitely a more gentle curve. Again, it is very much similar to what we are seeing in the year-over-year number for CPI. It is currently unchanged at 2.4%, although the market did expect it to worsen to 2.5%. Again, you can see that the bottom was actually traded 2 months ago, and this is again a reflection of how consumer prices are beginning to creep higher. And this is not just Germany. I think from the US onwards, you can see that inflation is definitely looking very troublesome, okay, because it looks like it has already bottomed and is looking to perk up higher. And with the world central banks now cutting interest rates, I think it may actually cause inflation to actually flare up all over again. And when you go into 2025, considering the Trump administration, the incoming Trump administration is going to be using tariff as a weapon to achieve their policies goal, it is definitely inflationary. From his taxation policy, he is looking to reduce taxation, which is good for businesses. But on the other hand, he wants to impose very punitive tariff on everybody else, okay, not just China, but I think on all their trading partners, and this will eventually be very, very inflationary. Okay, so going forward, I think 2025 is going to be seeing the returns of inflation in a very big way. Okay, so be positioned for that. Over in Japan, you can see that the consumer prices year over year has actually gotten a lot worse. 2.6%, but I think this is music to the ear for the Japanese central bank, because the Japanese central bank, the Bank of Japan, wanted to see inflation because they need to hike interest rates. And now with inflation year over year for November at 2.6%, which is practically a big jump from the last number that we saw in October at 1.8%. This is a massive, massive jump. Okay, and then on the core, which is you take away food and energy, on a year over year basis, it is also elevated at 2.2% compared to October number of 1.8%. So with this latest set of number, there is a very good likelihood this month when the Bank of Japan meets, they may actually hike interest rates. So when you hike interest rate, remember the last time they hiked interest rate to 2.5%, I'm sorry, to 0.25%, 0.25%, the stock market actually crumbled, okay, because that will unwind the very, very infamous carry trade, the yen carry trade. Because if the Japanese interest rates is moving higher, then those people who borrow Japanese to actually use the proceed to actually reinvest will have to unwind those trades. So if this is going to be the situation, there's a very good likelihood when the Bank of Japan meets later this month, there is a very high possibility, in my opinion, that they will hike interest rate. If they don't hike in December, in the next few months, I think the risk of the Bank of Japan hiking interest rates and also unwinding the yen carry trade is super high. The last time we saw it is that the Nikkei 225 actually crumbled. Will that happen again? I think you have to factor that in if you are exposed to the, let's say, the Japanese equity markets. Okay. Retail sales in Germany is again not good. You can see earlier on the month-over-month number has shown that the CPI has actually pedaled backwards into negative territory. And this is again confirmation that the German companies domestically cannot charge the right price for their goods and services. Retail sales has actually gone down, okay, and this is not good because the previous number was 3.8%. They only expected a okay lah, a dip to 3.2%, but it came in at a disastrous 1%. So this is definitely a major markdown in terms of the retail sales number. So we can see that retail sales is definitely very, very weak in Germany. And it is no surprise because we can see that since the start of the war in Ukraine, the biggest loser other than Ukraine has been Germany. Okay, and this is still being played out. Okay. There's another question here which I want to address here. Sam is saying, when will be the next BOJ rate decision? Definitely not this week. You have to go to the economic calendar. Okay, when we talk about economic calendar, I want to also remind you guys that my last webinar will be on December 22nd. Okay, after that, I will take a break, and you guys should also enjoy your holidays. And then before the year starts, we will come back again, and then keep your. I will post the next webinar on my Facebook page, and just watch out for the updates. Okay. Now, we have the Eurozone, okay, the harmonized index of consumer prices always follows one after the other. After Germany report their harmonized index of consumer prices, half an hour later, the Eurozone will announce them, okay? You can see month over month number, this is terrible. It has gone back into negative territory, and other than in January, this is about the worst number they can see. Okay, so there is a bit of a disinflation going on, perhaps even a deflation, because right now we can see the index is moving backwards into negative territory. This is not a good sign. Of course, month over month numbers are definitely more volatile. When you look at a year over year number on the chart on the right, you can see that both set of numbers are definitely not incongruent. And of course, there will be a delay effect. And you can see that inflation is remains elevated, while the month over month number is very concerning because we are beginning to see a slowdown in consumer spending in the whole euro area. Okay. Here we have GDP for Canada. This is a disaster as well. Okay. Q2 was 2.1%. It came in at 1%. Market also expected 1%. So it is definitely half of what it used to be just one quarter ago. So we can see that Canada is not in a good place right now. Now we have Trump threatening to impose 25% tariff on Canadian imports into the United States. Definitely, that's one of the reasons why the Prime Minister of Canada, Justin Trudeau, have to go to Florida to meet up with Trump. I think definitely he's very concerned because right now the Prime Minister is right now there is a movement asking him to resign. Okay, so definitely if the economy is not working out, there is every likelihood that the Prime Minister future may not be very bright. In fact, there has been a lot of complaint about how he's been running Canada. A lot of people are not very happy with the way he runs Canada, and definitely he may be asked to resign perhaps in the early part of 2025. So the economy right now is definitely not doing very, very well. Okay. In fact, when you compare the economy of the United States and Canada, it is like day and night. Okay, US at 2.8% is definitely way, way better than what we are seeing in Canada. Here we have China Purchasing Managers Index, which was released yesterday morning. We can see that China manufacturing and non-manufacturing are struggling. Okay, we can see manufacturing has seen hardly any growth. It remains stuck just above the 50 mark, whereas the non-manufacturing, referring to the services sector, is at the borderline case. Okay, it has actually shrunk from 50.2 to 50. So China economy, as far as the services sector is concerned, is not looking too great. In fact, when you look at the number has been fluctuating barely above 50, which is in the expansion zone, but barely. Okay, whereas the services sector is also not doing well. So net, you can see that for the last 6 months or so, China is definitely struggling with its economy. Okay. Here are the numbers to look for in the coming week itself. We have retail sales on Monday for Australia. No change. Again, we are also expecting the other sets of PMI, which is the one that the markets do watch, which is the Caixin manufacturing PMI. Again, no estimates, but it is, if we look at the regular PMI that we saw just a while ago, I think we can almost agree that it's not going to be a pretty picture. Okay, whereas the United States will be reporting their manufacturing PMI. It is still underwater, but it is nonetheless a slight improvement in terms of expectation. Previously it was 46.5, they're expecting 47.5. Both are in contraction zone. So manufacturing is definitely not growing in the United States. Okay. In midweek itself, with Australia reporting their Q3 GDP numbers, no estimate previously was 0.2%. And then China will be releasing their Caixin services PMI numbers. Again, no estimates. But this number here is definitely stronger than the regular number that we saw a while ago. Okay, because if you remember just moments ago, I showed you the services PMI, the non-manufacturing in China was at 50. Okay, borderline case. Here, no estimates here. It could very well go below 52. Okay. Then of course we have the all important labor report. We have the ADP employment change. Market expected a dip in number of jobs creation. Previous month, for a month of October, it was 233,000. Market now expect 166,000. Now remember last month, when they report their non-farm payroll, it was a disaster. Okay, it was only 12,000 jobs being created, largely due to the back-to-back hurricanes that we saw in the Gulf area, and definitely we're going to see a better number compared to, let's say, last month. Okay, so for the ISM services PMI numbers for the United States, they also likely to see a dip, and this is interesting because we are going into the festive season, and usually going into the festive season, the services sector tends to pick up because retail sales will pick up. People will be busy shopping, okay, for these holidays, and if this number don't pick up and instead is decreasing, that is a bit of a concern. Okay. Then on Thursday, we have trade balances for Australia. This number has never improved this whole of this year. Australia, that is economy is definitely on the rope. 4.65 billion Aussie dollars is not much different from the previous number of 4.61. Okay, so they don't see a big jump in their trade balances with the rest of the world. So that should not create any kind of major bounce in the Aussie dollars, in my opinion. So Eurozone will be announcing their retail sales for October. Year over year, no estimates here previously was 2.9. And then on Friday, we have a very busy day. On Friday, we have the GDP numbers for Eurozone, expecting no change from the previous release, both on the year over year and quarter over quarter. Okay. Then in Canada, we will be seeing their labor reports. Again, no estimates, so no need to go into that numbers here. But the non-farm payroll, we can see the non-farm payroll from 12,000, which is taking into consideration the strikes in Boeing, okay, and then we also have the back-to-back hurricanes, Helene, followed by Hurricane Milton, and both came in back on back and has created a lot of loss of jobs. Okay, but I think the rebuilding will see jobs coming back. So this 183,000 rebound in the number could be stronger than this number, for all I know, because of the rebuilding that needs to be done for all the damages done from Florida all the way to North Carolina. Okay. That unemployment rate is expected to remain unchanged at 4.1%. Now, 4.1%, remember this year, the highest number for unemployment rate in the US is 4.3%. So if we get a number higher than 4.1, the market is going to react negatively, okay? So do watch out for this unemployment number, although it is not a, what you call a high impact numbers, but still we will want to watch this number as well. The one that you want to watch is actually the average hourly earning. Month over month, we can expect, or rather the market expect a dip in earning. So we can see that Americans uh, earning, okay, has not caught up with inflation in a big way yet. You can see that this is definitely not a good number to expect. 0.3 is definitely not to be cheered, okay. However, if the number come in more than 0.4, that will be something, okay. Then the year over year number, no expectation previously was 4%. Then this will be wrapped up by the last data set for the week itself will be the Michigan Consumer Sentiment Index, expected to improve to 73.1 from 71.8. So there you have it, all the numbers that will be making the wave in the coming week itself. Raja Kumar is asking, for PMI, why is it categorized as contraction when the number is below 50? That is how the data set is being constructed. So it makes it very easy for us to follow. Just use a 50 mark as the guide. Anything above 50 is considered to be expansion, meaning say whether it is the services or the manufacturing sector, if the number is above 50, definitely that sector is doing okay. And if the numbers dip below 50, that sector, whether it's manufacturing or services, is seen to be contracting. So it is just the way they construct this index. So it makes it easier for people like us to actually follow. Okay. However, if the number is hovering near 40, like what we saw at during the lockdown periods back in 2020, that will be depression number. Okay, so not just 50. 50 is the borderline case. If the number is hovering anywhere near 40, that is telling us that particular sector is in a depression situation. So do watch out for this number as well. Okay, so this will be followed by the market outlook. Let me change my screen here to show you the chart. Hopefully you can see my chart, right? Okay, I'm going to show you the Dow Jones to begin with. Here you can see that I'm showing you the multiple time frame, okay, from the monthly. So again, this past week on the last day of November, okay, which is on Friday, we can see that the Dow Jones has gone up to all-time high again. So this market is definitely not looking to slow down. The market is still very buoyant. You can see that the Dow Jones is trading at 45,000 for the first time in its history. Okay, so we can see this is definitely telling us the market is in no mood to come down. When we look at the weekly structure, it is also telling us this market is definitely not slowing down in any form or manner. Okay, so as far as we can see, we know what is causing this, because earlier on, I think in the previous session, I have highlighted the possibility of capital flow into the United States. With all this escalation in the war in Europe, as far as Ukraine is concerned, and we knew last week that the Russian has actually fired a missile which they have never fired before in their life. Okay, and the world has actually saw Russia fire new weapons that use purely kinetic energy to actually hit the target. It created no fireball, it created no radiation, but the target in which this new missile hit has been left in the dust. Okay, so this is a new weapon, and this is causing NATO to be very concerned because they do not have a weapon to counter this new missile that Russia had just fired last week. Okay, and this is seen to be an escalation. And as far as Europe is concerned, capital is definitely leaving Europe because the risk of an escalation going into 2025 before Donald Trump gets into the White House again is very, very high. Okay, Donald Trump has hinted that he may want to negotiate a deal with Russia and end the war in Ukraine. And if the US actually pulls out of funding Ukraine, the Europeans, as far as the German, the French, the British, okay, they have actually said that they will continue to fund Ukraine. So definitely they want to keep the war going. So when you have a politician wanting to fan a war, definitely those areas you can see capital will flee first. Okay, and where do they go? Usually and typically and historically, they will flee across the Atlantic into the United States. Once the capital move into the States, they will be converted into dollars, and and this capital will be slogging around in risky assets such as equity markets. Okay, so this uh, latest upsurge in equity prices in the States is definitely fueled by this inflow of capital. Okay, so do watch out. The reason why we are seeing such strong performance in equity markets is definitely the case of capital inflow into the United States. But whether this can continue into 2025 remains to be seen. I was actually thinking that perhaps we will see a high in equity markets in the States in November. But on the last day of trading in November, on Friday, we see market created a new high. But we are going to the new month. Tomorrow onwards, if there is no follow-through buying, my idea of a top in November may still play out. So I want to see whether this week itself, this coming week itself, there will be any new high traded, especially in the Dow. Because right now the Dow is on fire. Okay, and we all know the Dow is definitely followed by the major money managers of the world. So if they are moving money into capital markets, into the stock market, we definitely cannot be selling just yet. Okay, and you can see the daily time frame. This is the daily time frame, very, very strong. There's no sign that the market is going to slow down. Very interestingly, we have not seen a major surge in the indicator here. Okay, there is no sign the market is about to come down. No sign at all. This is the 1 hour. No sign. Even the 5 minutes does not show us a big significant. This is only happening in the last half an hour before the market closes on Friday. Okay, we can see there was a bit of a profit taking, but this is 5 minutes. So in the bigger scheme of things, it may not mean anything. But this is typical profit taking before the market closes on the weekend. So when we look at the equity market, the other major index to watch will be the S&P 500. Now, again, I'm showing you the multiple time frame. This is the monthly time frame. I attempted to sell. It didn't quite work for me. Okay, and I believe I was stopped out again. Okay, but I was taking the chance that because in the lower time frame, I'm beginning to see some kind of reversal. But again, by the end of the closing on Friday, market ran back up to all-time high. So the S&P 500 is basically mimicking what we are seeing in the Dow Jones. Basically, very, very firm. You can see that this bar here is super strong. Okay, it closes near the top of the range for the month itself. Okay, so it's definitely not something to take light of. So we can see this is the weekly time frame, very, very strong, and there is no sign of a imminent reversal just yet. This is the daily, also very, very strong. So do not stand in the way of this market just yet. This is the 4 hours. You can see 4 hours. There's no other color other than green, meaning to say the market is currently very well bid. This is something that we want to watch. Okay, on the 1 hour, we're beginning to see some kind of profit taking. You can see that this candle bar here is definitely suggesting that maybe near term there will be some kind of profit taking, and that can be seen in the 5 minutes time frame. Okay, sharp profit taking towards the end of the trading on Friday itself, but it could mean nothing. Okay, we want to see how the rest of the new week pans out. If this new week we do not have a new high, okay, in either the Dow or the S&P 500, that to me is quite indicative that there's a possibility that the market has hit a peak so far for this year. Okay, just watch out for this coming week. Now, in the other index, such as the Nasdaq 100, you can see the Nasdaq 100, although it is there is no necessarily a new high traded. You can see that this is the monthly time frame. It did not close quite at the top of the range, but it is close enough. Okay, so this is the monthly time frame from the Nasdaq. From the weekly time frame, you can see that the high traded was actually 3 weeks ago. Okay, so this past week and the week before, okay, there was no new high. Okay, so I think if you want to look for weakness, I think it possibly could come from the Nasdaq. And considering the Nasdaq has been the catalyst that take the equity markets higher this year, now we can see that the Perhaps tech stocks are overvalued for all we know. Okay, and we have to watch how this thing is going to affect the other two index that we saw earlier on. So in the daily time frame, do we see a counter trend? Yes. This is the first time on the daily time frame that we see a major index having a counter trend. So it seems that there is already a counter trend in place in the Nasdaq 100, something that we have not seen in the Dow and the S&P 500. So definitely the money is not going into tech stocks. Okay, they are going into the blue chips as well as the S&P 500. Now, the S&P 500 has been the index to go to for retail traders. So if the S&P 500 continue to charge a new high, whereas the Nasdaq has not, that could be telling us that the retail investors possibly could be the last one in this bull market. Okay, so do watch out for, like I say, this coming week, whether a new high is going to be seen in all these three major equity markets. In the 4 hours, you can see that the market has been struggling to go higher. This 4 hours is quite telling to me there is no momentum behind. You can see the ADX is not even climbing at all. So on the 4 hours, in the near term, it does suggest that the Nasdaq is still the index to watch out for further weakness. Whether the weakness is going to spill over into the other two major equity index remains to be seen. But so far, we can see that this is a three wave, and market is going back up in a three wave as well. So again, there is no momentum behind it. In the 5 minutes, definitely we are beginning to see that there's a strong move up in the very, very near term. But again, if you look at the 4 hours and 1 hour, it definitely shows us that the Nasdaq is not as strong as the Dow and the S&P 500. Who here is asking that US indices usually are up in November to April? This is true in a sense because historically we are going into the window dressing period, meaning that companies and hedge fund managers want to be paid their bonuses and they want to keep the index high. So when the time comes to actually calculate their bonus, it will be based on their performance. Okay, so it is definitely logical to expect them to push the market higher so that it could hit the target. But once the window dressing is over, come January of next year, it could be a totally different ballgame. Okay, so again, watch out for the change in the period. Usually, it coincides with the change of period, not only month over month, but it's year over year. So the first week of January, or rather the whole month of January, is going to be quite interesting to watch. Okay, if there's no follow through buying, for all we know, the market could have already exhausted itself. Okay. So now we have finished with US equity markets. So let's go down to, let's say, the European theater. We look at the FTSE 100. Again, I previously mentioned that if you want to look for weakness, the weakness may not happen in United States. Okay, the weakness could come outside of United States. When we look at the European economy, is definitely not doing very, very well. It could very well come from those areas. Now, this is the FTSE 100. Now you can see that this FTSE 100. Now earlier on, if you notice, even the Nasdaq 100 do not have a counter trend on the monthly time frame, whereas on the FTSE 100 we see that in a monthly time frame. So on the relative basis, if we have to compare the bullishness of, let's say, the UK equity markets and Wall Street, for example, I would think you want to pay more attention to what's happening in Europe. UK is a major economy, and the fact that we have a counter trend in place already in the monthly time frame for the last 6 months or so is very, very telling. That means to say that for the last 6 months to 7 months, there has been no new high traded in the FTSE 100. So that shows us the relative weakness compared to those equity index in the United States. So if you have to sell or looking for a place to sell, if you want to do a counter trend trade, I think you may want to consider not selling the Wall Street index, instead to look into Europe. This is definitely one index you want to consider, okay, because it has to have no new high for the last 7 months, okay, 6 months, sorry. So this is the weekly time frame. You can see that the market has been struggling. It is not going higher, it's not coming down. So basically, it's in that consolidation with more downside potential. I think the area here at 7,912 may be seen again, and this is being the most optimistic. If we have a simple three-way pullback from the high of 8,418, there is every possibility it may go down again to challenge this level, targeting anywhere about 7,850 points. Okay, do watch out for this three-way. I think there's a very good possibility. There is a possibility of a good trade. Okay, here we have it on the daily time frame. Again, prices once goes into this very deep retracement levels, does offer us the opportunity. Anything above 8,310 is definitely something you want to consider, risking no more than 8,400. Okay, for this time frame. Okay, this is the FTSE 100. When we look at the 4 hours, for example, 4 hours has a major run up. Okay, but again, it has stopped. 1 hour is the same thing. Market has gone into sideways consolidation, really not really moving very much this week itself. But right now, the market just came off from the very deep retracement level. If there is nothing else I want to do, maybe I want to consider doing to trade counter trend on the FTSE 100. So this is the 5 minutes time frame. You can see 5 minutes just come off from the high, okay, at just under 8,300 points. Okay. There is, I believe, another question here. Let me grab this question. Raja Kumar is asking, the FTSE 100 is the same as UK? Yeah, different brokers use different symbol. It is the same index. Okay. Now let's take a look at the DAX, which is the German index. The German index, when we look at the higher time frame, the monthly, for example, now there is already not necessarily fully formed, okay, but the fact that it closed near the high, okay, does suggest that it may actually take out the high that we saw so far this year at 1,968.18. Okay, so because of the way the market closes in November, near the upper end of this trading range for the month of November, suggests that it may actually break through. So do not sell this index just yet. Now, remember the German economy is also not doing well. So the index itself is definitely not reflecting what we are seeing in the economy. Okay, the economy data coming in from Germany is pretty weak. So there is no justification in the DAX trading higher. But when we look at the price chart, maybe it is not ready to turn around just yet. Okay, so allow the market to find its place. Once it lose momentum, once the technical in line with the fundamental, selling it will be a lot more comfortable. Okay, so this is the weekly time frame. Again, you can see how the week close near on a close basis. This is possibly the highest closing we have ever seen in the DAX. Okay, close to close. The closing here was yeah, it's almost the same price as what we saw in October. Okay, daily time frame, no sign that the market is coming down. It was previously having a counter trend, but with this recent move up on Friday, it actually canceled out the counter trend. So on the daily time frame, it does suggest that a new high may be in the works, perhaps as early as tomorrow. So this is the 4 hours. Again, no counter trend. Shouldn't be doing this. There is already a dominant trend in place. Okay. So there is every likelihood we could see a new high coming up as early as tomorrow. No counter trend, so do not sell the DAX just yet. And there's another question here. Let me grab this new question. Oh, no new question. Okay, good. Oh, Raja Kumar has another question. Are the index FTSE 100 and Euro Stock 50 both covering the same region? That is Europe. There is a bit of a difference. The Euro Stocks has no UK listed company in the component index itself. Okay, the component stock that make up the Euro Stocks 50 are purely French and German companies. Has no UK company at all. Okay, but if you want to take a look at the Euro Stocks, it is definitely a European index. Okay, it has, like I said, no UK company that make up the component stocks. So it's a different index altogether. Okay. But again, since you mentioned the Euro stocks, let's take a look at Euro stocks. Euro stocks also very much in line with what we see in the FTSE 100. It has not had new high. This one is even worse. The Euro stock, this is 8 months. They do not have a new high. Okay, 8 months ago, the high was 5,120.4, and the market has not had new high. Okay, four months ago, we saw that there is a very, very strong pin bar, suggesting we will see higher prices. Typically, when we see a bar like this, it's going to be very explosive to the upside. But it only did trade higher the following month after the appearance of this pin bar on a monthly time frame. But you can see the last 2 months has been no follow through. So something is not right about this chart here. Okay, with this typical pin bar here, prices should practically blast off, but it did not. Okay, the last 2 months is very indicative that the European economy is not doing well. Okay, so when you want to look at DAX, maybe you want to look at Euro stock instead. Okay, there's something not right about the DAX trading at near high. Okay, here we have the index here having a counter trend in place on the monthly time frame. I think there's another new question here. Let me grab this new question. Sam is asking why the Euro stocks no new high. I have no idea. Okay, the German DAX, which is purely German listed companies, are trading at near record high. In fact, it closes so strong on Friday that there is the risk that it will burst out in the new high in this coming week itself. But Euro stock is more now because it has majority, I think 60% are French listed company, maybe 30 to 40 odd percent are German companies. So it's definitely a bit of a tilt towards the French economy. So you use it to watch the two biggest economy in Europe, which is Germany and France. They are definitely on the road. Okay, I cannot explain why the DAX is as strong as it is. Okay, but Euro stock is actually quite telling. And in the weekly time frame, you can see that the market is struggling already. And it looks like there could be a three wave. And if the market does do a three wave, over the last 3 weeks, you can see there's a bit of a support developing in this index here. Okay. We have a pin bar, we have another pin bar this week itself. So we can see that the market has a little bit of support, okay, near the lower end of this index here. So we can see, but by and large, it could be a three wave, meaning to say the market may take out this low here that we saw, okay, at 4,471. Just trade with the higher time frame. This is the daily. The daily definitely is also showing us possibility market will gradually go lower and take out the 4,471. And once the prices go into this blue area, just watch out for maybe the re-emerging of buying interest. If the market can hold, well and good, okay, but the market cannot hold and go below 4,379, the bull market is definitely over. Okay, so I'm not going to go down to a lower time frame because very few people trade the Euro stocks. Okay, but it's definitely something to watch. Like I said, if you are bearish on equity markets, thinking that they are overvalued, maybe you get better chance selling the European index rather than the any of the Wall Street index, even the Nasdaq 100. So let's go to the Pacific. Look at Japan. Earlier on, we saw the CPI numbers for Japan in Tokyo has actually surged, giving rise to the possibility that the Bank of Japan may actually be hiking rates when they meet this month, okay, in December for the last time for 2024. And if they do, the last time we saw this move, this is everything to do with the yen carry trade. So if this is going to be a repeat of what the Bank of Japan did at the early part of the year, we could logically expect and maybe something similar to happen all over again. Okay, so the monthly time frame already has a dominant trend in place, and this is actually quite deep. Again, very similar to what we saw in the Euro stock. This pin bar here is so strong. Okay, market went down all the way from 42,000, almost 500, down to 30,400, and then it bounced back so strongly. Logically, the following months that follow, okay, should actually saw a burst to the upside, taking out the high. But over the last 3 months, we can see that the market has no impetus to go higher. The market is stuck just about 40,000. Okay, so again, maybe another market to watch. Okay, considering that the CPI numbers for Tokyo is so robust at 2.6%. Okay, we definitely wants to think ahead as to what the Bank of Japan may do when they finally meet. Okay, and will they be looking to high interest rates? Because the last time they high interest rates, the Federal Reserve wasn't very happy. Okay, so did the Japanese get the message from the Federal Reserve? Not sure, okay? Because there's a lot more than just reacting to data set. Because Japan being beholden to the United States. Ideally, in the perfect world, they will have to consult the Federal Reserve before they change the monetary policy. Okay, obviously, the last time they changed the monetary policy by intervening first in the currency market to support the yen and then hiking interest rates. We could logically deduce that they did not consult the Federal Reserve, okay, or the U.S. Treasury. So I think they have been sending them a message. You will notice that shortly after the Bank of Japan came in to intervene in the currency market by supporting the yen and then hiking interest rates, the previous prime minister resigned. He didn't resign, but he actually didn't put his name in for re-election. So that tells us a lot. There's a lot of political pressure behind the scene that resulted in him not able to withstand the pressure and decided that he doesn't want a job anymore. Okay, so the current prime minister, although he doesn't have majority, okay, in the diet, which is their version of the parliament, it shows that he is a hawk. He wanted, uh, based on his previous speeches and stand, he definitely wants the Bank of Japan to normalize monetary policy, which is to go back to something of a normal. Because in the decades, we have seen the Bank of Japan has experimented with a lot of unconventional monetary policy, such as negative interest rates. So now we are out of negative interest rates. Will that be the sense in which, with the Prime Minister blessing, the Bank of Japan can actually normalize monetary policy by getting interest rates more or less in line with the rest of the world. Okay, but right now, if the Bank of Japan actually high interest rate, they are going against the grain because the rest of the G7 economies, central banks are cutting rates, and if Japan started to high interest rates again, they may not get into the good books of the other G7 nations. Okay, but Japan has their own problem which they have to deal with on their own. So this is the weekly time frame. The market is definitely struggling. Okay, so whether you can sell this market or not depends. You have to watch this. Okay, but I think there is good scope. Okay, the market is definitely not riding higher. I think there is every possibility that this low that we see here at 30,379 may be seen again. Okay, so watch out for further weakness in the Nikkei 225. 4 hours time frame is showing us that near term there is a possibility of more downside. In a 1 hour, definitely the market here has a lot of room to go. So let me grab this new question that has popped up. Wei Ren is asking, Ishiba has also retracted its hawkish stand on the yen. I think, like I say, you have to toe the line. Right now, the United States is definitely not comfortable with Japan doing something that is exact opposite of what they want to do. Okay, obviously the condition in Japan is very different. Okay, they are trying to short the value of the yen because you can see that the Japanese companies have parked their money outside of Japan. They are waiting for the time whereby the yen can stabilize and hopefully strengthen before they move back those earnings from overseas back into Japan. Okay, so again, we want to see how the politicians in Japan will react. Okay, right now we want to look into Hong Kong. Hong Kong market has a bit of a rundown for October, December. We can see that for the month of October, the Hang Seng actually went to the high, but this is a three wave. This is a classical three wave. What do I mean by classical three wave? This bounce here from the beginning of the year at 14,600. Okay, end up as a three wave. You can see that the market hit 100% at 22,883. Okay, the high traded at 23,264. Okay, it went in marginally above the equality move and then ended October as a pin bar. And November has seen no bounce in the index itself. So we can see that technically speaking, the Hang Seng remains very vulnerable. Okay. On the weekly time frame, you can see that the sharp sell-off from the high here at 23,264 has been pretty sharp, except for this week itself, this past week, okay, which had a bit of a bounce. The Hang Seng has been falling since the high was traded for the year. So on a net basis, I think the market is waiting for new stimulus package. And I think the Chinese government would not want to roll out any more new stimulus package until they are very sure of what Donald Trump would do when he finally gets into the White House. Because if you use up all your chips and then you do not have any more chips to play, and then with Donald Trump come up with a curveball, they would have no way to react. So I think they are keeping the powder dry, and then I think they will be watching how Donald Trump is going to be behaving for the first 6 months of 2025. So I think there could be more firepower going to be lined up as far as China is concerned. So there is still that scope. But for now, we can say this is a three-way bounce and end up with this move here is definitely, technically speaking, not a very good development. Okay, but still, the Hang Seng market has been so cheap. Okay, this is the 4 hours. 4 hours, you're beginning to see that the market has stabilized, but there is no momentum behind this, although the index is climbing. Right? If you, for the brave soul who dare to go in to buy, okay, hopefully you want to buy at more sensible area. I would think anything about 19,200 is a more sensible area to consider. Okay, I'm definitely have no position in the Hang Seng right now. All right, now we are finished with equity markets. Let's jump into the currencies. We will start off with euro dollar. Now, euro dollar has a bit of a pullback this week. It has a bit of a bounce, but overall we can see that the euro dollar is definitely very weak. This is the long-term outlook for the euro dollar on a monthly time frame. So this market is in the long-term downtrend. Okay, so for 2 months in a row, October, November, the euro has actually been sliding down. Okay, so that is the overall picture that we are seeing. The market is definitely bearish. Okay, we have a bit of a bounce at the beginning of the year, but no, not at the beginning of the year. This one actually started in 2022. Okay, so this bounce can only be seen to be a big cat bounce. I am long-term bearish on the euro. So this is the weekly time frame. You can see the weekly time frame has seen the market went up only to a high of 1.1275, and the latest challenge is only at 1.1214, and the market has been coming down since. This is the weekly time frame. This week we have a bit of a bounce in the euro, okay, which also coincide with the pullback, in that dollar index. Okay, the low traded in the euro so far on the weekly time frame was a fortnight ago at 1.0324. But I do see lower prices. Right now, we can see that there is a three-way pullback, market hit equality, and then we have this bounce. So technically speaking, near term, we could possibly see a little bit more of this bounce that we are seeing in the euro. In fact, across the board, all major currencies seems to be bouncing off their most recent low. Daily time frame, you can see the market hit this very deep retracement area. By and large, you can see that the market is basically, if I minimize this, you can see that the market is basically doing sideways. Okay, now the bounce comes at 1.0333. So this bounce here definitely comes from a very, very interesting area, which is what I consider to be a very deep retracement. So technically speaking, there could be some kind of a decade bounce, but I don't expect any major trend to evolve, because on the daily time frame, what we are seeing here is that the market has gone to a consolidation period. Okay, whether this is going to be a drop-based drop or or a rally-based rally, I remain to be seen. Okay, if you believe this to be a rally-based rally going beyond 112.75, that means it could very well be a larger degree three-way. For all I know, this could be what we are seeing. Instead of here, we're going to move it over here. So if this is the case, if you believe this is going to be a rally-based rally, I can't get this into. I'm going to get a magnet. Okay. If this is the case, top side, we could be looking at here. Okay. 1.15. Okay. If we dare to do this trade, which I am not in favor of. Okay. But for those who are doing shorter term trade, you can take this as a chance to actually continue to buy the bounce. Okay. Now, in the 4 hours, you can see that the market has that bit of a bounce. Okay, but this bounce is very, very tentative. Immediately, we can see that the high here at 1.0610 is going to be a big problem. Okay, the nearest swing high, the market has to close above this level, 1.0610. On the 1 hour time frame, if the market takes out the 1.0610, that means the 1 hour time frame will turn bullish, very bullish. Okay, so do watch out for development in the euros. Now, very much in line with what we are seeing, the euro is the sterling. Sterling is also in a long-term downtrend. Okay, this bounce that we see in 2022 in September of that year, you can see that this is part of a bounce. So far, the high has not been able to go much higher beyond the previous high at 142.40. So again, this is part of a technical bounce. It's not a change of direction. So in the weekly time frame, you can see that this bounce here is still very much in play. Right? In the daily time frame, you can see that the market also attempt to go lower, but you can see on the relative basis, the sterling is marginally stronger compared to say the euro. Okay, so there is that slight difference. And in the 4 hours, the market has hit some kind of a pocket here. Unless the market can take out 127.70, it will come under selling pressure. But we will have to watch this level. The moment the market take out 127.70, it will open up to more gains ahead. But for now, on a 4 hours time frame, this could be the one price level to beat, 127.70. Now, after we cover the Europeans, let's take a look at the dollar versus the yen. Now, dollar yen on the monthly time frame, okay, we can see that the high is 162, the low is 130, 139.60. This has been the range of trading. And for the month of November, market went up to a high of 156.75, and it closed on the low of the monthly range. Not a good development. Okay. And then on the weekly time frame, you can see this sell-off this week has been a little bit steep. So if this continued to be the case, the yen has strengthened. Okay, and I think a lot had to do with the CPI numbers that we saw released this week for Tokyo. And expectation is that if the inflation numbers for the CPI is as strong as what we saw at 2.6%, there is every expectation that the Bank of Japan may actually have the cover to hike interest rates. So if that being the case, the yen strengthening is reasonable. Okay, in the daily time frame, we can see that except for Thursday, the market has been coming down this entire week. So going forward, will we see a bigger degree pullback below the low that we see here at 137.24? I think there is very good chance. Okay, if we see dollar yen at this level, at anything below 137, I think we should also expect a reasonable corresponding pullback in the Nikkei 225. So this is the dollar versus the yen. On the 4 hours time frame, it has turned bearish. You can see that there's no green color box, purely all pink. And this is also the case in a 1 hour. So near term, the dollar looks like it may continue to trade lower, especially against the yen. What about dollar Canadian? Dollar Canadian is still very much elevated. This is the monthly time frame, okay, but the trading range for the dollar CAC is actually quite wide, from just under 147 to 120. So this is a very, very wide range of trading. It's quite interesting. You can see that this November itself, the market actually edged higher to 141, almost 80. Okay, but it did not manage to close at the upper end of this trading month, the monthly trading range. On the weekly time frame, you can see that the market has actually lost some momentum here. And the last bar for the week is actually very interesting. You can see this is a pin bar. A pin bar suggests that this being the pin bar is actually a technically a bearish development. And you want to look at the daily time frame to see if you can see that as well. Yeah, we can see that this bar itself, okay, on Tuesday actually destroy the overall technical outlook. Okay. And in the coming week, if we have a close below the lowest point that we saw this past week, I think it's safe to say that the dollar Canadian high is possibly in place, at least for the near term. Okay. In the 4 hours, you can see that the market has not been able to go much higher beyond the previous channel support now turn resistance, right? Very neat. And now the price is coming back down, and if it goes below 138.15, I think the entire structure looks like it will topple over. Now, let's take a look at Aussie dollars. I forgot to show you the Aussie dollars. Now, this is the monthly time frame. We see a bit of a bounce in Aussie, but the Aussie bounce has been very, very limited. Okay, has been very tentative. There has been no corresponding rally in the Aussie, unlike the euro dollar. Okay, so we can see on a relative basis, the Aussie does looks a little bit on the downside. In the weekly time frame, you can see that the market has been struggling, has not been able to bounce significantly, even though the other major currency has bounced relative to the dollar. Okay, so we want to see how these things will play out. On a relative basis, I think the Aussie remains very, very well offered. Daily time frame, the moment the market goes, the Aussie versus the dollar goes below 0.63 half, I think it's all over. This will have to be redrawn. Okay, meaning say the market will turn decidedly bearish. So watch out. Okay, if you're going to be basically bearish on currency, maybe the Aussie market is going to be one good currency to watch. Now the other one which I don't normally cover is the Kiwi dollars. Okay, Kiwi dollars also did not bounce. On a month-to-month basis, it remains pretty well offered. So I think the Kiwi dollars, because the central bank has been actively cutting interest rates, so there is no reason why the Kiwi should strengthen against the dollar. So I think it's very much in line with the fundamentals here. The weekly time frame has seen that the Kiwi have a bit of a bounce ever since that Reserve Bank of New Zealand actually hiked rates. But I think it's seen in the overall perspective. I think the market is sideways from at best. Okay, but it is near the lower end of this range, of this trading range. The low traded is 57 cents. So the low traded this past week is at just under 58 cents. Close enough. Okay, I don't think there's anything worth doing in the Kiwi at this moment in time. I don't see any trading opportunity. All right, I'm done with currencies. I want to show you, there's a couple of questions here. Maybe there are more questions on currencies. Let me grab this few questions here. Raja Kumar is asking, Euro region is doing very bad considering Germany GDP's low, war, etc. But why the euro dollars is rebounding? Like I said, currency sometimes takes turns to bounce. Okay, now this week is how we see the dollar pull back. It's not so much on the strength of the euro. It is that the dollar has been rebounding. Earlier on, I did mention, right, the low in the euro dollar in the dollar index was actually traded on September 27. I think 99 point something, okay, and it bounced all the way to 107.99, okay, so just under 108, and that has represent a 8%, more than 8% bounce in the dollar. So it's only this past week that the dollar come back down, okay. So this is a pullback in a week after a 2 months rally in the dollar. So you got to see things in perspective, because this week we see the dollar come off after a 2 months rally. Okay, that it also means, corresponding speaking, the dollar, the major currencies like the euro dollar will have to bounce, because it's like a seesaw, right? One currency rate goes down, the other currency goes up. It's always in opposite direction. It's not so much on the strength of the euro, but nothing to do with the GDP. Why it does not warrant the euro to be able to bounce. Okay, overall we can see that the euro is going down. We can see that the DAX remains strong, but I can see the euro remains on a defensive. Suman is asking, what is the best currency pair for upcoming week? You have to make your own decision. I've shown you the outlook for the various major pair. You have to make your own conclusion. Okay. Now, why is Kiwi dollars so strong after New Zealand cut rates? Is always the case, right? Once the central bank cut rates, the next logical question trader will ask, what is the next move? Will there be more further cuts? Let's say, for example, during the next meeting in December. So if the answer is no, then there's no more reason to sell the currency, right? So because New Zealand, the Bank of New Zealand, the Reserve Bank of New Zealand has been actively cutting interest rates. So they have been one of the more proactive central banks. Okay. So the question here is, as we move into December, will there be another rate cut? If the answer is not sure or unlikely, then there's no more reason, like I said, to sell the currency. So opposite of this narrative would be, I need to cover back my shorts. So it's not necessarily new buyers coming in to buy. It could be the people who have previously shorted the Kiwi dollars now are covering the position by buying back their short position. So again, okay, it is not clear cut. It could be due to many reasons. And one of the reasons is just what I just mentioned. Could be short covering. Okay, right. I want to talk about commodities. Let's talk about crude oil. Now, crude oil has not been able to do anything of significance. It has been trading on the lower range. It attempted to bounce, but it couldn't bounce in any meaningful way. Okay, you can see that I actually gone wrong. Okay, so this is the area of very deep retracement. Technically speaking, I think anywhere south of 76 cent, 70, no, 73 cents, $73 is actually quite a good area to consider to build up long positions. I want to buy some more if the market goes any lower than, let's say, $65. I will consider buying some more. Okay, my threshold will be at $57 and maybe 50 cents. Okay, I'm prepared to take this market all the way down to this level. Okay, so long as this level is not violated, I think over time, it will all work out because of the escalation of war going forward and how politicians in Europe are hell bent to actually keep the war going. So if that been the case, I think that will logically means that we could see higher energy prices going forward. And right now, although we have a peace, so-called peace deal in place between Israel and Lebanon, but if the peace is not durable, okay, earlier on, I did mention that 24 hours after the peace deal was announced, uh, Israeli broke it, okay, by firing into southern Lebanon. So more sensitive in the Middle East because I do not believe that Israel will end the war. Okay, I think they have unfinished business, and I think it's definitely not going to be a positive outcome. Right, and you can see the daily time frame, the weekly time frame. You can see the market has been building a base. Now, this is quite interesting. It's building a base. Okay, and although this week itself it end up negative, okay, but I think by and large I am still very comfortable with going long crude oil. This is of course the WTI, the West Texas Intermediate crude oil. Okay, on the daily you can see the market is also within the this blue colored area, which is to me the very low risk high reward trade setup. I will still consider looking to accumulate if I can. So in the 4 hours, you can see prices. If you go back into the $67, I will continue to see if I can see a buying signal appear, and then I will want to go in and buy some more. Okay, you can see my exposure is very small. I'm just doing a tentative long. So this is crude oil and long-term bullish on crude oil. Let's take a look at gold. I believe there's a couple of new questions being asked. All right, thank you, Jim. Now, this is spot gold. Gold prices has been very strong. We have all-time high at $2,790 last month in October, but this month we do not have follow-through buying. I think near term we possibly will see further weakness in the gold. I think going forward, long term, I'm very bullish on precious metals because I think we are definitely going to see uh, uh, worsening of the geopolitics going forward. So gold did not react to inflation, but it's definitely reacting to the unstable nature of the geopolitics that we have seen for the last 2.5 years. So I think going forward, war is definitely going to be reversed for some time, and that will be the catalyst to take prices of gold even higher. Now, Trump, hopefully nothing happens to him from now until this inauguration day. There are about 40 days left. Now, 40 days is a long time in politics, okay? If nothing else untoward happens to him, assuming he safely get back into the White House, whether he can last the entirety of his term remains to be seen. I am not confident, okay, that he can last the 4 years because he simply has too much enemies, and his enemies is hell bent to doing it. Okay, so will that lead to further domestic violence in the United States? Now, Trump has many supporters, and that has been very evident in the result on November 5th. Okay, he managed to get a very strong mandate, and if he's eliminated for whatever reason, okay, especially to his personal safety, then that will be the catalyst to actually see the U.S. descend into total chaos. Okay, and that could actually cause gold prices to shoot to the moon. Okay, so continue to monitor how uh, uh, Trump handled his safety. Definitely, he has not moved out of Mar-a-Lago for the last few weeks since his November 5th victory. So I think he is definitely very concerned about his personal safety. So we have to continue to watch how this thing unfolds. So in the in the weekly time frame, we can see the market has attempted to rally the week before, and now it has lost back half of its value of the rally that we saw the week before. So technically speaking, I think there is still more scope for continued correction, but I think this is just a correction. If prices of gold can trade back to 2005, 2004, I think that will be one good area to consider again by looking at the chart one more time to see if there's going to be any good entry levels to reposition long. Okay, this market here, if assuming the high here traded this past week is at $2,721.40, this could see a three wave, meaning to say the market may trade lower than the low so far at $2,536.80. Three wave, I think there's a very good chance here. Now, this level here that we see, this is a natural support area. Okay, this was the previous high, and the market has been like more acting like a pivot. Okay, so $2,431 could be the bottom for this move. Okay, assuming this is just a simple three-way pullback. So look out for levels. I have no goal position right now, and I'm just waiting for a chance to see if I can reposition, get back into the game. Now, if you use the 4 hours time frame as the three-way pullback, equality, let's see where it will go. This is the 4 hours time frame, by the way. Okay, it's not exactly accurate. It's $2,467. When you compare that to the daily time frame, $2,431. Close enough. Okay, close enough. So, like I said, this area here, this line, okay, at 2,431 is a natural support, technically speaking. Okay, this is very much in line with what we are seeing here. Okay. Okay, this is my outlook for gold. I think near term we possibly will see further pullback. Okay. And then when we look at silver, silver again has been underperforming. Okay, we saw the market has been doing a three-wave rally, but it doesn't seem to have that momentum behind the critical momentum that is still missing. When we look at silver, we consider this. The market has not even hit the quality. Okay, but I think at some point, I think silver will have to rotate its role relative to gold. Especially right now, you can see that gold has lost its momentum to the upside. I think perhaps traders will be taking another look at silver. So there's every possibility that silver will outperform gold in the weeks ahead. So instead of looking for gold to stabilize at $2,431, maybe the near term, there could be a better performance in the silver markets. Okay, we have to watch this in the daily, weekly time frame. Daily itself, near term, not quite strong. Okay, the nearest support is at $26 per ounce. So depending on the structure, right now we don't have a very clean structure yet in the silver market. So like I said, you want to keep an eye open for silver. Hopefully silver will outperform. Okay. Last week, Tandy, you asked about platinum. Okay, so this week I got platinum to share with you. I'm not sure today you are in the room, but anyway, I will show you platinum just the same. Okay. Now, platinum, this is the monthly time frame. Market is well supported. The market has not been rallying these past 2 years. The high was traded at $1,317. That is back in 2020. So for the last 2 years, there has been no new high, unlike gold. Okay, so maybe the money is not in platinum. Okay, the structure looks like the market is basing, so lower to buy, in my opinion, if the market still want to go down. So this is the daily time frame. We have a bit of a bounce this week on the daily time frame on Friday. Friday, you see a bit of an uptick, but the market has went up to as low as $900. Okay, so not sure whether this $900 will come back again, but there is no definitive reversal signal, at least not in this time frame. 4 hours has hit its near-term target ABC. Okay, there's nothing to see in platinum. If you want to be exposed to precious metal, maybe platinum is not where you want to look. Now, the last but not the least, I will be talking about Bitcoin. Now, this week itself, the big news is not in Bitcoin. Okay, Bitcoin continue to be very well elevated. Okay, it's again going having another go at the $100,000 value. Okay, so perhaps going into the new week, we could see Bitcoin finally touching the 100,000. Okay, but be careful about this number because it's a very nice rounded number. Okay, so once the market hit 100,000, do not go into chase. For all we know, we could see a wave of profit taking coming out if the market hit the $100,000 per coin levels. Okay, this is definitely not a place to buy. In the weekly time frame, you can see the market is also quite elevated. Now this is quite current. Okay, so like I said, this week the market focus is not on Bitcoin. Ethereum has actually benefited. Okay, because we heard that the SEC chairman is going to resign the moment Donald Trump goes back to the White House. So it has actually rallied quite strongly. So for the month of November, the single one news that kick up the Ethereum prices is actually news that the SEC chairman is going to step down. Okay, so that has been seen to be positive. Okay, and we also see a record inflow into let's say BlackRock ETF, the Ethereum ETF. So that has also been positive. In fact, there has been net inflow of funds going into both the BTC as well as the Ethereum ETF. So those two has been positive on crypto prices. On the weekly time frame, you can see the market has been very, very strong. Okay, but it needs to break out of 40,000. No, sorry, 4,000. It needs to break out of 4,000. If we break out 4,000, then of course it will be into another phase. Okay, for all we know, this could be part of the ABC move, looking to take out the $4,860 per coin. So this could be seen to be in the light. If the market take out the $3,975, it will definitely be challenging this new high. So overall, it looks to be very impressive. I think the odds of further gains in crypto is definitely there. Okay. Now, the one that actually has benefited this week is this. This is Ripple. Okay. Now, Ripple has been in a legal tangle with the SEC, but the latest news comes out is a separate case where the judge in California may actually be ruling in favor of Ethereum. Now, remember, not Ethereum, Ripple. Now, Ripple has been caught in a lawsuit because the SEC has accused them of selling a securities when they do not have a security license. They deem Ripple to be a security. Okay, so if the court in California rules in favor of Ripple, which I think the market is interpreting it to be a good news, then there's a very good chance the case with SEC may also be in their favor. So by and large, you can see Ethereum, this Ripple has actually gone up by 20% this past week. So this is massive. So I think the market right now is looking at Ripple right now. You see, this is as strong as it can be. This is to me what looks like a third wave. Okay, a third wave is deemed to be the strongest and the most aggressive part of any wave theory. So this is almost parabolic. So if this is not third wave, I don't know what you can consider it to be a third wave. So technically speaking, Ripples does appear to have a lot more upside potential. Very, very strong. You can see this is like a cobra, right? The market has been doing sideways and then suddenly embraced it. Okay, so this is definitely very, very bullish. I don't think we have seen a high. I think the market right now is looking at the high so far is about just under $2. There is a possibility once the market breaks and close above $2, it will go for $2.30 perhaps. Okay, so there is a lot more potential upside in Ripple. Very, very strong. Okay, so if there's anything you want to do in crypto, maybe you should take a look at Ripple. Ripple is right now in a stage whereby I think we have not seen the top just yet. All right, guys, is there anything that you want me to cover? Let me check if there's any more new questions. Yes, anonymous attendee, not sure who you are, but let's say, so you are accumulating crude oil using CFDs. I trade CFDs, not necessarily using only CFDs to accumulate long position in crude oil. Okay. I also look into futures. Okay, so you can also say that I'm going to hold this position for a while because I think the political outlook is actually quite negative. Okay. So if we are looking to hold longer, what instrument will I recommend? Uh, we are traders. So again, I'm not sure what is your time horizon. I can hold position for a very long time. Okay, so I'm not too concerned. So if you are not comfortable doing it through the CFD, you can consider doing through a futures contracts. Okay, then just continue to roll over. It's definitely something that you can consider. Okay. Now, Dennis is asking for December this year, are we able to see targets gold price? Like I say, for now, I think the market for gold is looking to correct, and I don't think the correction is over just yet. Okay, I did mention 2000, $2,431. So that could be something to look forward to. I believe that the bottom is not in place yet, but overall, I'm very bullish. Okay, I hope these are all the things that you want me to talk about. And like I said, my last webinar for 2024 will be on 22nd of December. Thereafter, look out for updates in my Facebook. All right, guys. Thank you very much for the evening and wishing you guys happy holidays ahead. Bye-bye.